This video will help you understand some strategies to reduce the tax impact of required minimum distributions. If you don't know who I am, my name is Chris Dime. I'm a financial planner out of Edmonds, Washington, and I specialize in working with folks to and through retirement. As you get older, or at least if you have loved ones getting older, you're going to run into the problem of required minimum distributions. And this is ultimately where at a certain point in your 70s, the IRS mandates that you withdraw a certain sum of money from your pre-tax retirement accounts every single year until the day you pass away. These mandatory withdrawals from your pre-tax retirement account come with income taxes because the money's never been taxed, and they're technically called required minimum distributions, or RMDs for short. In today's video, we're going to walk through some strategies to reduce the tax impact of RMDs on your retirement plan, ultimately leading you to have more money in your retirement. So let's jump in. In my last two videos, we touched on how RMDs work, which I'll link above here. I think that's a good fundamental starting place to understand how the IRS expects you to calculate these RMDs, when they're due, etc. Then we talked through a few examples on how to calculate your required minimum distribution once you start aging into RMD territory, sometime in your early to mid 70s. The focus of today's video, though, will be on some strategies you can employ once you understand how RMDs work to ideally limit the impact of taxes on your RMDs, which ultimately just means you'll have more money to use in your retirement, thus helping you never run out of money, which is arguably the number one goal for most retirees. So as mentioned briefly earlier, but just to quickly summarize, required minimum distributions are mandatory withdrawals you must make from your pre-tax retirement accounts, things like pre-tax 401ks, traditional IRAs, pre-tax 403bs, 457bs, etc. They're due on December 31st every year once an RMD is applicable. Failure to correctly calculate your required minimum distribution and ultimately distributing too little means you'll owe the IRS a 25% tax penalty on the amount of undistributed RMD. So if your RMD this year was 50 grand and you pulled out 30 grand, you'll be assessed 25% in taxes on $20,000, the missed amount of RMD. Not to mention, as soon as you do finally pull out that 20 grand and get back into the IRS's good graces, that withdrawal is income taxable because this is all pre-tax money. So not only do you get hit with a 25% penalty tax, but you also get income taxes to go along with it. To quickly refresh our memory as well, when do RMDs start? Well, they start in your early to mid 70s, and it's going to be based on when you were born. Now, in the context of an inherited retirement account that comes with its own required minimum distributions, that's beyond the scope of today's video. I've got some other explainer videos that break those down in more detail, but this focus is solely on when do your personal RMDs start for your own personal retirement accounts. If you were born before July 1949, then your RMD start date was 70 and a half. If you were born between July 1949 and 1950, then your RMD start date was when you turned 72. And if you were born between 1951 and 1959, then your RMD start date was or will be the calendar year in which you turned 73. For everybody else, as of now, aka if you were born in 1960 or later, your RMD start date is going to be age 75, which doesn't apply to anybody right now here based on the calendar year of 2025, but it will be applicable in the future. So why do you even want to worry about strategizing to minimize the impact of required minimum distributions? It's all income taxable, right? So it doesn't matter if you take it out this year, next year, etc. You're paying income taxes. Well, technically, you don't have to worry about RMDs if you don't want to. All you have to do is take out the mandatory withdrawal. However, planning reactively, aka every year doing the math and then taking out what you have to take out, will leave you with one result. Whereas if you can strategize a more proactive financial plan, you can absolutely tangibly decrease the amount of taxes you'll pay over the lifetime of your retirement. So how would strategies reduce the impact of taxes? Well, there's a number of different ways that we can strategize this. Let's first start off with some easy math, which would be federal income taxes. The federal income tax system is built on a marginal basis. And what that means is as you make more and more money, certain brackets of income, the higher in income brackets you go, you'll pay a higher percentage or a more confiscatory percentage in taxes on said income. This is in contrast to say like a flat tax system where whether you make 100 grand or $1 million, you pay 10% of your income in taxes. The federal income tax system is not developed that way. We'll touch on this strategy later on in the video, but ultimately what you don't want to philosophically do is delay all of your pre-tax retirement account distributions until as late as possible, aka RMD start date, because at that point, based on what your expenses are in retirement, it might not make sense because you're going to get hit with income taxes at potentially a much higher federal income tax bracket at that stage of your life. Instead, the math would oftentimes nod its head towards pulling out a level amount of distributions over as long of a time span as possible, aka the beginning of retirement until you assume mortality, thus resulting in a smaller effective amount of income taxes you're paying on the same amount of total distributions you're going to make from this IRA over your lifetime. Now, I'm not an expert in state income taxes, mostly because Washington state doesn't have a state income tax, but I imagine it's a similar concept where you probably want to avoid delaying all of your pre-tax distributions until as late as possible and then paying a bunch of taxes every single year. The math would probably lend itself also to taking out smaller level distributions over as long of a time span as possible. Now, of course, you'll have to check with your specific state and how they do state income taxes, but I imagine the concept's pretty similar. Another concern with batching massive required minimum distributions once you're in your 70s, as opposed to leveling out those distributions over time, is the impact of Social Security income taxes. I've got an explainer video that I'll link above here as to how to calculate your Social Security income taxes when you are receiving Social Security benefits in retirement. But to keep it very simple, the more income you show in retirement, aka retirement account withdrawals on a taxable basis, the more of your Social Security payment check gets dragged back into your income taxes for the purposes of calculating how much you'll owe the IRS in income taxes. AKA, the more you make, the more you'll pay in taxes on your Social Security income. This calculation is called the provisional income or combined income calculation, but ultimately, you'll pay less in taxes the less income you show in retirement. And similar to federal income taxes, those brackets to determine how much of your Social Security income gets dragged back into adjusted gross income is done on a marginal basis. So the more you show, the more you pay. So again, you'll see a theme here that the less we can show in income in retirement, the less you'll pay in taxes. The last concern for folks in retirement would be IRMAA, or Income Related Monthly Adjustment Amount, aka a surcharge on how much you're paying for Medicare once you're in your mid-60s and later. I've got a video that explains this in a little bit more detail, but ultimately you also want to avoid showing lots of income in retirement, because the more you show an income in retirement, the more you could end up paying for Medicare Part B and D. And that concern should start in the year you age into age 63, because Medicare has a 2-year look back for determining whether or not you made too much money and now need to pay a Medicare surcharge, aka more than everybody else. Okay, so we've touched on some problems with why you don't want to just wait until RMDs start to start planning around them. You probably want to get a handle ahead of time and might even want to look into leveling out distributions over time. But there's some other strategies to be aware of. Depending on how your income will batch throughout the year, whether you're still working or you expect to, sell a business or whatever, you might want to look into delaying your required minimum distributions. And there's 3 main ways to do that. The first way is to delay your first ever required minimum distribution. First ever required minimum distributions, aka in the calendar year in which you age into your respective RMD age, you are allowed to delay your required minimum distribution until April 1 in the calendar year following that calendar year. So if I turn 73 in 2025, I'm going to have an RMD calculation to do for the tax year of 2025. But I don't have to distribute that RMD by December 31st of this year. I can wait until April 1 of 2026. But in 2026, I also need to take out by December 31st of 2026, 2026's RMD. So I delay my first RMD, but I don't eliminate the tax impact. And based on how your income might structure throughout your retirement and when you age into that year, it may or may not make sense to delay that year's RMD or to pull it by December 31st, even though you're allowed to delay. Another way in which you can delay required minimum distributions would be under the still working clause. So if you're still employed with an employer that offers a retirement plan, you can roll either all of your IRAs into that 401k if they permit it, or at least know that 401k distributions you are allowed to delay for the purposes of RMDs if you are still working at that company. Now, your employer may or may not permit this. I don't know why they wouldn't, but ultimately, if you're still employed by an employer and you're not a 5% or more owner of said employer, you are legally permitted to delay taking out required minimum distributions from that employer-sponsored plan, even though you've aged into RMD territory. Now, in the year in which you separate, whenever that happens, you'll have RMDs starting on December 31st of that year. But until such a time, you're allowed to let that money continue to compound. Again, that may or may not make sense from a tax standpoint. Odds are, if you're still working, the year you stop working, you're going to have less income. So in those circumstances, it can make a lot of sense to delay. The third strategy to delay required minimum distributions would be through the use of a QLAC, or a qualified longevity annuity contract. I've got an explainer video up here, and I'm not the biggest fan of QLACs, but I don't want you to not know that there is a strategy to delay required minimum distributions until you're 85 years old. For the tax year of 2025, the maximum amount of your pre-tax IRA you're allowed to defer into a qualified longevity annuity contract is $210,000. Back in the day, there was a percentage of IRA limit, aka you couldn't put in more than 25% of your IRA balances into a QLAC. That's no longer the case after some Secure Act updates. So the maximum is $210,000. And is that going to move the needle or not move the needle for a retiree delaying their RMDs till 85? It absolutely could. So it's something to be aware of and strategize around. Now the downside is you're no longer having access to this IRA money, 210 grand at a maximum, that you put into this annuity contract. The good news is, however, the money that gets removed from your IRA into that annuity is no longer part of the overall RMD calculation. And if you watch the previous video on how to do the RMD calculation, you'll find that the larger your IRA balance, the larger your required minimum distribution, all things being equal. So if by moving 210 grand into an annuity contract decreases your total IRA balance, by definition, your RMD in an alternate scenario is much lower. But like I said before, the downside is you're buying an annuity, the money is no longer accessible to you to the same degree, and if you think you would have gotten a better rate of return inside the IRA rather than investing in this annuity contract, well then that's by definition not a very good investment. Another strategy to reduce the impact of required minimum distributions is to use your RMD for a charitable cause. Now, doing something for charity, especially when there's tax incentives involved, rarely mean that you make money out of doing this. Fundamentally, you're donating money to a charitable cause. But I want you to understand the tax impact of donating your required minimum distribution. And this is through what's technically called a qualified charitable distribution. I'll link above to a further explainer video on how these work, but ultimately, every year when you get hit with how much you'll need to take out of your account for an RMD, you can either choose to take that money out, have it get factored into your adjusted gross income, and maybe itemize deductions later on if you stroke a check to a charity or you make further donations, whatever. But a more tax efficient way to donate to any charitable institutions that you want to is simply to have your IRA stroke a check to the 501c3 charitable organization or nonprofit organization. And while that money does come out of your IRA to do that, you don't get hit with the income taxes that result from taking money out of your pre-tax IRA. And as opposed to itemizing, gifts you make to a charity, which are limited. If you were to gift cash, for example, the most liberal of tax treatment, you're only allowed to itemize 60% of your AGI by way of that donation. So if your income this year was 100 grand and you gifted to a charity 100 grand, you're only allowed to itemize a deduction for $60,000. Whereas if your income this year was 100 grand and your RMD was 100 grand, you could stroke a check to the nonprofit for 100 grand or however much money your required minimum distribution was. Now the limit on a qualified charitable distribution for 2025 is $108,000. So if your RMD was 200 grand, you'd only be able to QCD 108,000 out. You'd still have to pull out the remainder and pay income taxes and all that jazz. But if you and a spouse have similar sized IRAs and you both want to do this strategy, you can both employ qualified charitably distributing $108,000 each. Now that gets a little bit tricky because if let's say there's only one IRA on the balance sheet, but this couple is married, you can't donate $216,000 out of one spouse's IRA and still have it qualify for the QCD rules. The $108,000 maximum has to come individually from two different owner IRAs. So depending on whether or not you're charitably inclined, you might as well look into donating your RMD if you are charitably inclined, as opposed to simply stroking a check out of the bank account every year if you gift a reliable amount. So we touched on this earlier in the video, but you definitely want to look into, if nothing else, spreading out the distributions from your IRA. This strategy is called tax bracket management, and it's something I'll push out another video on sometime down the road. But ultimately, as opposed to waiting until RMDs kick in and then heavily distributing from your pre-tax retirement account. You might instead want to do a mathematical projection and say, okay, I estimate a decade or two in the future, this will be how much my IRA is worth, and here will be all of my RMDs. If you can start distributing from that IRA earlier, going back to our knowledge on federal income tax brackets, it might totally make sense from a tax standpoint to take a little bit of pre-tax money out every single year over time, rather than not at all until RMDs start and then heavy distributions. From a tax standpoint, you'll probably end up paying more in taxes if you do the latter. It might make sense to do the former and level out distributions over time. I think Benjamin Brandt talks about this in one of his podcasts, the perfect required minimum distribution. And if you're not listening to Benjamin Brandt's podcast, I would recommend it if you're a podcaster. His podcast is called Retirement Starts Today. I'm going to link it down below. It's definitely worth to listen to. But he talks about the perfect required minimum distribution. Once you've solved for how much you'll owe in the future and you start thinking about how much you'll need to pull out, essentially you can reverse engineer and find out, okay, I spend 10 grand a month and my RMD in my 70s will be 120 grand. Well, obviously I'm being very simplistic, but that's the perfect RMD. You're taking out exactly as much as you need to pay all your bills. And while that may or may not be the most efficient strategy, I think what he's trying to highlight is do the math ahead of time so that RMDs aren't a problem. You're not fed on income and then the IRS forcing you to take more in, even if you don't need it. That just results in more taxes that you don't want to pay. The last strategy I'll highlight is doing Roth conversions ahead of time. I find this is the most receptive strategy for clients I work with, and it's because it's pretty intuitive. Would you rather pay income taxes when you have to at whatever tax rates are in the future, knowing about federal income taxes and how you probably don't want to be pulling out income at the higher levels if you don't have to? Might you find value in the year after retiring, when your income's arguably probably as low as it's ever going to be, doing Roth conversions? And for a quick refresher, Roth conversions are when you take money from a pre-tax retirement account and you move it into a Roth retirement account. Roth retirement accounts nowadays don't have required minimum distributions ever. So once you move money from a pre-tax account to a Roth account and that money grows and compounds tax-free, you've got way more tax flexibility in retirement to decide which wells of income you're going to pull distributions from to pay all your bills. Now, the price of admission to move money from a pre-tax retirement account into a Roth is income taxes on however much money you Roth convert. You don't have to Roth convert everything. You can, very similarly to distributions, spread out your Roth conversions for as long as possible throughout your retirement. Even in the years that you have a required minimum distribution, you're still allowed to do Roth conversions. Now, once the math has been done, aka it's January 1st, and you could do the math and figure out how much you owe for a required minimum distribution, you can't Roth convert that away. That dollar lump sum has to come out of the account by December 31st. But anything above and beyond that, you could still Roth convert. So the strategy doesn't end just because you've aged into RMD territory. Again, it all comes back down to the math on projected taxes. Does it make sense to wait? Does it make sense to do a big old Roth conversion? Or generally, does it make more sense in the year after retiring, say age 60, until RMDs start, say mid-70s, we level out some Roth conversions every year, pay some taxes, but at a lower effective tax bracket than we project we'll be in when RMDs start. So that was kind of a lot, but hopefully that was helpful in at least highlighting some strategies and some control you have as a taxpayer to, with foresight, look ahead to how best to strategize around minimizing the impact of taxes on your required minimum distributions. From a calls to action standpoint, there's probably two things I would want to make sure you do. Number one, know when RMDs kick in for you, so know when that impending doom is. And then number two, think through some strategies ahead of time, whether it's Roth converting or from a tax bracket management standpoint, pulling out a little bit of money from your pre-tax accounts, even if you don't have to, for income in retirement. Ultimately trying to level out the effective tax bracket you'll owe on all of your RMDs. Hope that was helpful. If you have further questions, drop them in the comments below or get in touch with the website. We'll help you get squared away. Have an awesome rest of your day, and we'll talk to you later. Bye.